Investing wisely. Investment decisions today are more personal than ever. Some individuals prefer selecting stocks on their own, while others choose mutual funds managed by professionals. The debate between direct equity picking and investing in mutual fund units reflects different risk appetites, knowledge levels, and financial goals. Let us first understand direct equity picking. In this method, an individual investor personally selects and invests in shares of companies listed on the stock exchange. For example, buying shares of companies like Reliance, TCS, or HDFC Bank directly through a Demat account is direct equity investing. The biggest advantage of direct equity is complete control. Investors can choose which company to invest in, when to buy, and when to sell. If the company performs well, the returns can be very high. Direct equity also avoids fund management fees, which means higher potential net returns. However, direct equity comes with higher risk. It requires strong market knowledge, time for research, and emotional discipline. A wrong stock selection can lead to major losses. Market volatility affects individual stocks more sharply, and beginners may panic during downturns. On the other hand, we have mutual fund units. In mutual funds, money from many investors is pooled together and managed by professional fund managers. The fund invests in a diversified portfolio of stocks, bonds, or other securities. The biggest benefit of mutual funds is diversification. Even with a small amount of money, investors can gain exposure to multiple companies. This reduces risk compared to investing in a single stock. Mutual funds are also professionally managed, making them suitable for individuals who lack time or expertise. Additionally, options like SIPs, systematic investment plans, make investing disciplined and affordable. Investors can start with small amounts and build wealth gradually. However, mutual funds have management fees and expense ratios. Investors also have less control over individual stock selection. Returns may be slightly lower than successful direct equity investing, but the risk is comparatively balanced. Now, why do individuals choose one over the other? Young investors with high risk tolerance and market knowledge may prefer direct equity to maximize returns. Working professionals, beginners, or risk-averse individuals often prefer mutual funds for stability and convenience. Psychologically, direct equity investors enjoy active involvement and decision-making. Mutual fund investors prefer peace of mind and professional handling of funds. In conclusion, both investment options have their own advantages and limitations. Direct equity offers higher return potential with higher risk and effort. Mutual funds offer diversification, professional management, and comparatively lower risk. The best choice depends on an individual's financial goals, risk tolerance, knowledge, and time availability. A balanced approach, combining both direct equity and mutual funds, can also be an effective strategy for long-term wealth creation. Investment is not about choosing the best option universally, but about choosing the option that best fits you. In today's evolving financial world, individuals are becoming more aware and active about their investment choices. Among the most debated options are direct equity picking and mutual fund units. Both avenues provide opportunities for wealth creation, yet they attract different types of investors based on personality, knowledge, financial goals, and risk tolerance. Let us begin with direct equity picking. Direct equity means buying shares of specific companies listed on the stock exchange through a Demat and trading account. Here, the investor personally selects companies after analyzing financial statements, industry trends, management quality, and market conditions. The biggest attraction of direct equity investing is the potential for higher returns. If an investor correctly identifies a strong company at the right time, the capital appreciation can be significant. There are no intermediary management fees, and investors have full control over entry and exit decisions. Another important advantage is ownership transparency. Investors know exactly which company they own and how it is performing. This creates a sense of involvement and control. However, this approach demands time, skill, and emotional stability. Stock markets are volatile. Prices fluctuate daily due to economic news, global events, and investor sentiment. Without proper research and discipline, investors may make impulsive decisions driven by fear or greed. Concentration risk is also high if the investor invests heavily in only a few stocks. Now let us understand mutual fund units. A mutual fund pools money from many investors and invests in a diversified portfolio managed by professional fund managers.